What if the market actually told you the crash was coming days before it happened? On the previous analysis published on GB Economy, a very specific warning was laid out. If silver failed to hold the 150-hour exponential moving average near $90, the structure would likely break, and price could slide toward $84.90 or lower. That level wasn't random. The 150 EMA on the hourly chart had been acting as dynamic support throughout the recent rally, meaning that once it failed, algorithmic selling and momentum traders could accelerate the downside. And that's exactly what happened. After the level broke, Western spot silver quickly dropped to around $79, while silver futures traded near $81 as selling pressure intensified across global markets. The key point here is that this was not hindsight analysis. The warning was documented, publicly posted, and time-stamped before the move occurred, giving traders a clear condition and outcome instead of vague predictions. One level, one scenario, one result. If you want more breakdowns like this, where macro signals, technical structure, and real market data come together before the move happens, make sure you subscribe to the GB Economy channel, because in volatile markets like this, preparation matters far more than reaction. But once that technical level broke, the move in silver didn't happen in isolation. It unfolded at the exact same time the entire global financial system was experiencing a sudden liquidity shock. In a window of roughly 80 minutes during the latest trading session, the combined precious metals market saw nearly $1 trillion in value wiped out. Gold fell about 2%, erasing roughly $740 billion in market capitalization, while silver plunged 10 to 11%, removing an estimated $260 billion from the sector. Moves of that scale rarely occur without broader systemic pressure, and the rest of the market confirmed it. On the same day, the U.S. dollar index climbed about 1%, pushing toward levels last seen in mid-January, a signal that investors were rushing into cash. Meanwhile, equity markets across major economies turned sharply lower. Germany's DAX index dropped around 4%, NASDAQ futures fell roughly 2.5%, and S&P 500 futures declined close to 2%, reflecting widespread risk-off sentiment across global portfolios. At the same time, the energy market was flashing an entirely different type of alarm. European natural gas prices surged more than 70% in just 2 trading days, an extraordinary move that suggests severe stress in energy supply expectations. When you place all of these signals together, metals collapsing, equities falling, the dollar surging, and energy prices exploding, it paints a clear picture. This was not a normal market reaction to routine news. It was the signature of a system-wide liquidity shock, where funds, institutions, and algorithms simultaneously scramble for cash, forcing liquidation across multiple asset classes at once. At first glance, the behavior of silver during this period looks completely irrational. Geopolitical tensions in the Middle East have been escalating rapidly, with energy infrastructure becoming direct targets. In recent days, key oil routes and facilities across the region have faced disruption risks, including attacks on infrastructure linked to Gulf energy transport. Historically, events like these tend to push precious metals higher as investors search for safety. Yet despite this backdrop, silver experienced one of the sharpest short-term declines in recent months. The explanation lies in the dual identity of silver within the global economy. Unlike gold, which functions primarily as a monetary asset, roughly 50–60% of silver demand comes from industrial applications, including solar panels, electronics, electric vehicles, artificial intelligence, hardware, and defense manufacturing. When financial markets begin pricing in the possibility of an economic slowdown or recession, assets tied to industrial growth often face immediate selling pressure. In those moments, algorithms and institutional risk models shift capital toward the most defensive assets first. The typical order of reaction during growth fears is remarkably consistent across decades of market data. Gold holds value best because it has virtually no industrial dependency. Silver comes next, as its industrial exposure makes it more sensitive to economic expectations. After that, platinum and copper tend to fall even harder, since they are even more tightly linked to manufacturing activity. In other words, while the geopolitical narrative suggests higher precious metals prices, the macroeconomic narrative fear of slowing growth can temporarily dominate trading behavior, pushing silver lower even during periods of escalating global conflict. However, the price action becomes far more interesting when you look beyond a single market and compare where silver is trading globally. While Western markets experienced a sharp sell-off, prices in Asia tell a noticeably different story. As the latest trading session unfolded, Western spot silver was trading around $79, with COMEX futures near $81. Yet at the same moment, on the other side of the world, the Shanghai spot market was holding close to $91, and Shanghai futures were trading around $92. That creates a striking gap of roughly $10 to $12 per ounce between Western and Chinese markets, even after the aggressive sell-off in New York and London. Such a divergence is not common in highly liquid global commodities and typically signals that different forces are driving pricing in different regions. Western markets are dominated by paper contracts, derivatives, and leveraged trading, which can amplify short-term volatility during liquidity shocks. In contrast, Asian markets, particularly Shanghai, tend to reflect stronger physical demand from industrial buyers, refiners, and state-linked participants. When a premium of this magnitude appears, it suggests that while paper markets may be under heavy selling pressure, physical demand in parts of the world remains firm. In other words, the headline price decline in Western markets does not necessarily mean global demand for physical silver is collapsing. This divergence becomes even more striking when you examine the gold-silver ratio across different layers of the market. In the paper trading environment, the ratio currently sits near 62 to 1, meaning it takes about 62 ounces of silver to equal the price of 1 ounce of gold. On the surface, that might seem normal, because historically the ratio has fluctuated between 50 and 80 during periods of financial stress. But once you compare it with the physical reality of supply, the imbalance becomes much clearer. From a mining perspective, the global production ratio is roughly 7 ounces of silver for every 1 ounce of gold. Inside major storage systems, the numbers also tell a different story. Data from COMEX vaults shows a ratio closer to 11 to 1, while inventories reported within the LBMA system indicate something closer to 3, 1-inch certain categories of deliverable metal. If you expand the lens further to estimate above-ground accessible supply, the ratio approaches 1. 1-inch some analyses of investment-grade bullion. When these layers are placed side by side, one conclusion becomes difficult to ignore. The paper pricing mechanism is dramatically disconnected from the underlying physical structure of the market. History shows that when such gaps widen too far, they rarely persist indefinitely. Eventually, either paper prices adjust upward for silver, or the structure of the market itself is forced to reset. And when we shift the focus from ratios to actual physical supply signals, several indicators begin pointing in the same direction. One of the most unusual developments recently came from the Shanghai Gold Exchange, SGE. In its latest weekly market report covering February 24-27, the exchange continued publishing detailed trading data for gold, but the inventory lines for silver suddenly appeared blank, despite the SGE historically reporting those numbers every week. At the same time, stress signals have started appearing in the lending market for physical metal. Silver lease rates have been rising, meaning the cost of borrowing physical silver is increasing. Meanwhile, the swap structure has begun turning negative, a condition that can signal tightening supply in the near-term delivery market. The vault data from the United States tells a similar story. According to the latest COMEX vault reports, approximately 2.8 million ounces of silver were withdrawn in a single day, pulled from major storage locations including Brinks, CNT, Delaware Depository, and JP Morgan facilities. More importantly, while some silver has moved between categories, the overall COMEX inventory continues trending lower on a net basis. When these indicators appear together, missing inventory disclosures, rising lease rates, negative swap signals, and steady vault withdrawals, they tend to emerge during periods when physical silver supply is becoming increasingly tight beneath the surface of the paper market. When price moves become this extreme, another layer of the market inevitably comes into focus, the structure of large institutional trading. One development that has attracted attention is the growing position of Jane Street, a major global trading firm, which recently became one of the largest shareholders of the BlackRock iShares Silver Trust, SLV. Regulatory filings show the firm accumulated more than 20 million shares in a single quarter, representing a notable stake in one of the largest silver ETFs in the world. Firms like Jane Street are widely known for strategies that combine large underlying positions with even larger derivatives exposure, including options and volatility-based trades. The structure is straightforward in modern markets. Build a position in the asset, trade substantial derivatives around that position, and profit from the volatility created as price swings intensify. At the same time, it is important to remember that the physical silver backing SLV is stored by JP Morgan, a bank that previously paid nearly $1 billion in fines to U.S. regulators in 2020 to settle investigations related to precious metals market manipulation. When these structural realities intersect with a market event, such as silver dropping roughly 11% in just 80 minutes, it naturally raises questions among market participants. While volatility can occur for many legitimate reasons, the combination of large institutional positioning, derivatives-driven trading, and historical manipulation cases can make such sudden price collapses appear far less random than they initially seem. Beyond market structure and trading dynamics, the broader geopolitical backdrop is also intensifying at a rapid pace, particularly across the global energy system. In recent days, several developments across the Middle East have raised concerns about the stability of key oil and gas supply routes. One of the most notable incidents involved a major explosion near the port of Fujairah in the United Arab Emirates, one of the region's most critical oil export hubs and a strategic route that allows tankers to bypass the Strait of Hormuz. At nearly the same time, reports indicated that operations at Iraq's Rumaila oil field, one of the largest in the world, were partially halted, threatening production capacity of roughly 1.5 million barrels per day, which represents close to 30% of Iraq's total oil output. Meanwhile, a major Saudi refinery was forced offline, tightening refining capacity in the Gulf region. On the gas side of the market, Qatar's liquefied natural gas exports, responsible for roughly 20% of global LNG supply, have faced disruptions, adding further pressure to already volatile energy markets. These events are unfolding alongside rising political tension. The United States has warned that Iran could be preparing missile or drone attacks targeting Saudi infrastructure, while China has publicly opposed U.S. and Israeli military actions in the region, signaling a widening diplomatic divide among major powers. When taken together, these developments highlight a growing risk to the global energy transportation network, particularly in and around the Persian Gulf, where nearly 1/5 of the world's oil supply normally passes through maritime routes each day. In an environment like this, even small disruptions can ripple rapidly across global markets. Even with tightening physical signals and rising geopolitical risk, it is important to acknowledge that short-term downside scenarios for silver can still exist. The first warning sign is technical. As discussed earlier, silver lost the 150-hour exponential moving average near $90, a level that had acted as structural support throughout the recent rally. Once that level failed, the chart structure weakened, and momentum algorithms began accelerating the move lower, pushing Western spot prices toward the $79 area. At the same time, the U.S. dollar has been strengthening, with the dollar index climbing roughly 1% in the latest session and approaching levels last seen around January 15. Because precious metals are priced in dollars, a stronger USD typically creates additional headwinds for gold and silver in the short term. Another signal worth watching comes from the equity side of the sector. Western silver mining stocks have not been rising in line with the earlier surge in silver prices, a divergence that sometimes indicates institutional investors remain cautious about the sustainability of the move. When mining equities lag the underlying metal, it can suggest that capital is not fully committing to the bullish narrative yet. Most importantly, during system-wide liquidity stress, correlations across markets tend to converge. In those moments, investors and funds often sell whatever they can to raise cash. That means even fundamentally strong assets, including precious metals, can temporarily decline simply because liquidity becomes the dominant priority in global markets. So when we step back and connect all these layers together, the key conclusion becomes clearer. Yes, silver prices have dropped sharply in the short term, with Western spot recently trading near $79 after losing major technical support. But despite that price movement, several fundamental indicators underneath the market have not changed. Physical inventories continue to trend lower in major storage systems, including the recent withdrawal of roughly 2.8 million ounces from COMEX vaults. At the same time, silver lease rates have been rising, signaling that the cost of borrowing physical metal is increasing, while the swap structure has been turning negative, both conditions that historically appear when supply tightens. In Asia, the picture also looks different from the Western paper markets. Shanghai prices have continued trading roughly $10, $12 higher than New York in recent sessions, showing that physical demand in parts of the world remains strong even while futures markets experience heavy volatility. Meanwhile, the gold-to-silver ratio in paper markets remains near 62-1, a level that still appears significantly disconnected from mining production ratios and certain physical inventory estimates. Adding to this shift, there are increasing reports that some companies are beginning to consider physical silver as part of treasury management strategies, a development rarely seen during earlier market cycles. Taken together, these signals suggest that watching the paper price alone may not provide the full picture of the silver market. Thank you for watching the video, and if you have a different perspective on the market, feel free to share your thoughts in the comments section below.